Bloomberg is now on your dashboard. With Apple CarPlay and Android Auto, it gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. It's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers.
Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. All right, let's talk stocks. Let's talk stocks that pay dividends. And we do that with our David Bahnsen. He's a founder and chief investment officer at the Bahnsen Group. David, we've got, probably since the last time we talked, we had a nice move up in rates, kind of, and I guess the question is, dividend-paying stocks. How do you think about dividend-paying stocks in the context of, hey, I can sit in a 2-year treasury and get 4.96% here?
Yeah, it's a very good question. And I think that when the 2-year was at 0% for 15 years, people got a feel for what my answer is going to be. The 2-year is not going to stay at 4.96.
Right.
And if let's say you buy it and then in 2 years it's still at 4.96, it won't be, and it isn't growing. That's the issue with dividend growth, is the growth.
Okay.
Not only do you get something that is consistently going to be at the level at which you enter, it's going to grow year over year. With fixed income,
hopefully, right? I mean, there have been companies like BP or Disney that have cut dividends.
It would be very, very important for a dividend growth manager to not allow dividend cuts to happen. So in 25 years, we've never had one, and I intend to go the rest of my career without one. But there are certainly companies that cut dividends, and we really don't recommend people
You don't get blindsided by something like BP? I mean,
yeah, BP gave plenty of forecasts that what was happening. You had both President Obama and the former candidate John McCain recommending the same thing, that they ring-fenced $20 billion of liability damage around it. There was no way they were going to do that and keep the dividend. So it gave people months of time to sell before the dividend was cut.
That's why I needed someone like him, because I didn't know.
I didn't know that.
A career maker for me was Citigroup in 2007. They came out and announced that they were continuing to pay the dividend. And at that point, it was up to about 7% yield. The stock was down. And then they borrowed $11 billion from the Kuwaitis and Saudi Arabian Sovereign Wealth Fund. And I said, I don't think people taking advance on their credit card to pay a dividend counts. It has to come from free cash flow. They have to have lower leverage. You have to have a good balance sheet. You have to have a business model that leads to sustainable free cash flow. That's why we have to be actively managing.
So how many names are in your portfolio?
Right now, 33 names.
33.
We've never had more than 35 in my whole career.
And you're focusing exclusively on dividend growth, right?
Yes.
And how do you define, what's a good policy if I'm a CFO to plan my dividends? Is it a percentage of earnings? Is it a percentage of free cash flow? It's
interesting. Dividend payout ratios refer to a percentage of earnings that are paid out, but we like to look at the free cash flow and what percentage of that's being paid out. And I think most CFOs in America are used to annualizing a dividend, even if earnings or free cash flow may be somewhat lumpy throughout the year. I think it's a much better way to do it and affect their growth one time a year, as opposed to kind of going up and down. We have, I think, 3 companies in the portfolio, and it's Blackstone, Apollo, and Blue Owl. They're asset managers that get carry, and carry is intrinsically lumpy, so they tend to pay it a little lumpier. But most just pay it in a systematic quarterly way.
So the ETF is TBG, the Bahnsen Group, pretty easy to remember. And so I click TBG Equity DES into the Bloomberg, and then I can click the Holdings tab, and I see Simon Properties as your top holding. Now, Paul and I don't know exactly what's in Simon Properties' portfolio, but Paul and I talk about commercial real estate with angst and fear every day.
Well, you're making a really bullish argument, by the way, for a contrarian investor, which is to say a good investor. But let me explain what's going on with Simon Property. It's 272 of the best malls in America. They have given the keys back for 4 of them. They were non-recourse. So they lost a little bit of equity and the lenders had to go fight. Okay. Right now, they have the highest occupancy in the history of Simon Property at the highest per foot in the history of Simon Property, 96.9%. They've taken positions in some of the retailers that have failed. There are going to be more that fail. Now they've learned to monetize that. They took JCPenney for $500,000 a box. It was trading at $20 million a box. They're selling some to Amazon. They're reconverting some into condos and mixed use. It's this massive collection of real estate that can be repurposed, monetized into something more valuable. While they do that, we get an over 7% yield, entirely covered by net operating income, and the leverage is at about 47%. It was 65% before the financial crisis.
All right, number 2 is Verizon. That makes total sense to me, obviously, as a dividend play. Number 3, International Business Machine, Big Blue.
One of the great names people could buy, and this is an idea of a model we like a lot. You have old businesses that don't grow a lot, paying you a ton of free cash flow, with new businesses that are sort of not priced in, that represent a free call option. Will they become a real leader in artificial intelligence? I don't know. I think they will, but I do know this: it's not priced in the stock at all. The stock is entirely priced off a multiple of its book value of a kind of more old, stodgier businesses, but they have basically turned most of the business into software and consulting recurring revenue. So we love IBM. You get 5% dividend yield. The Red Hat acquisition was expensive, but they're monetizing it. So IBM's a great dividend grower for years to come.
All right, I'm heading down to Duke University this afternoon, and I may or may not bump into Tim Cook, CEO of Apple. If I were to get you two guys in a room talking dividends, what would you tell him?
Well, I would not tell him anything that others much smarter and more prestigious than me have not also told him, and they have failed, and so I'm sure I would fail. But what Apple's doing is shameful. And the inability to monetize that level of enterprise value, I think, is unacceptable. They will not do something with that $200 billion as profitable as returning it to shareholders. They bought Dr. Dre's headphone company for $3 billion. It wasn't worth $900 million soaking wet. But who cares? It's
right.
Apple. They make it in 5 minutes. My point is, in aggregate, you can set money on fire when you don't have an adequate shareholder return policy. They are a victim of their own success. This cannot be said as a criticism. They generate too much free cash flow to reinvest all of it. It has to be returned to shareholders. There ought to be a very large, juicy dividend coming back to shareholders. Now, here's the thing. They're going to do it. Steve Jobs wouldn't do it. Tim Cook did end up doing a small one.
Yep.
They grew so much, the yield is now 0.5 percentage point. I don't know if it's in a year or 10 years, but every one of these arrogant, cool tech companies finds out that at some point you have a higher return on equity returning this to shareholders. So all of the companies from the 90s that didn't do it, Cisco, Microsoft, Qualcomm, they all became great dividend growers later. Apple will as well. They're just not there yet.
You said you're going to talk to him.
I'm going to talk to him.
And you're going to tell him.
I'm going to say, I talked to this guy, David Bahnsen. He has a firm. It's his firm.
Yeah.
In Newport Beach, California. That's the beach.
Yeah.
Yet he spends 3 weeks a month here in New York. What are you doing, my man?
You
It's
know,
your company. It's 3 weeks there, maybe a week here to talk to the eggheads in New York.
I really love to work, and I think you'll find the work ethic is a little more impressive in Manhattan than Newport Beach.
Are there other people that do like this intensive dividend strategy that you do?
There are other dividend growth managers. There are not. You mentioned this ETF that is active. Most ETFs that people own in the dividend growth space are passive, and I vehemently disagree with that approach. I think it's better than nothing. But we have built quite a business around active dividend growth, and it's what I built my career around. I believe in it very much.
Sold us.
The Bahnsen Group.
First time we walked
I'm trying
in
to
here.
get him on the ETF IQ program.
Do it. I think do a little remote out there in La La Land.
Yeah, we should definitely do it from Newport Beach.
No, but instead we're going downtown to Lower Manhattan.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
Disney reported numbers last night. I thought pretty good. They're cutting costs, so the stock's up. But quite frankly, folks, I've been doing this media stuff for almost 30 years. I have no idea how these companies are going to transition to this new streaming model, but who cares? Because we have somebody who's really, really smart on this stuff. Michael Nathanson, he's a founding partner and senior research analyst at Moffettnathanson. Michael, thanks so much for joining us here. Again, I'm like most investors, like I don't know where to go with these media stocks. What did you hear from Disney last night?
Well, I think what we heard from Disney that made a difference was they gave you cash flow guidance that made people feel more comfortable with the valuation. And you also heard that they're going to spend less on content going forward. And again, like it feels to us, and you said this before about streaming, there was just overspending on streaming. People were throwing money at it left and right. And it feels to me that there's some rationality coming back and that Disney is going to spend less on cash content spend. And that's going to basically drive free cash flow. And to me, if you look at Disney's earnings, it's essentially a parks company. So I don't want them blowing money on streaming if there's no return on capital. So I'm pretty happy with this outcome because we've been saying forever, like this is a parks company and media is becoming less and less important here because it's going down every day in terms of profitability, as you know very well.
So is it important to you to know whether they're in or out of streaming? A lot of people have said, I want to know, their strategy in regards to streaming. Netflix obviously also spends like a drunken sailor on content creating, but Netflix rules the roost, right? So, I mean, what's the point of spending less? Why not just be out of it?
Well, they can't, at this point, they can't be out of it. Their view is that Disney should have a direct relationship with consumers as they do in the theme parks, right? And for the long history of media, Disney never knew its true consumers, right? It was always a third party was doing distribution. So I think Disney can't be out of it. The question is, how much should Disney be in it, right? Should they be competing with Netflix or should they be a smaller, more targeted service for Disney superfans? And that's been our contention all along. You don't have to be Netflix. You have to make a Disney Plus product for your core fans. There's less of them. You can charge more money. That's probably a better business. And we've been saying that. Like, do not be Netflix. It's not a business you want to be in. And they're listening, I think. I think they're realizing that they have a great, great business model as is, and they need to basically just make sure their fans are being nourished, not overspend on things that are not core.
All right, so if they're going to be focusing on their core fans primarily through their parks business, what do you do with all the other stuff? They've kind of got a big studio operation. They kind of got a bunch of linear cable and broadcast networks. What do you do with all that stuff?
Okay, well, studio is key because if you think about, you've known this for your studio is a way to refresh the characters in the park. Like the flywheel starts with studio and IP.
It has to happen. I watched Cinderella last night, by the way, with my 3-year-old daughter. And at one point, one mouse says, "Let's leave the sewing to the women." And I thought, I should not be showing her the 1950 version.
No, well, there's a long list of movies from that era you should not be showing her for that same reason. But the view is, look, we've been debating with the company openly that we don't know why ABC and ESPN need to be part of that new company, right? And the company has not really said what they want to sell. But like our theory is at the heart of Disney is the IP. Then you have consumer products and theme parks and films. But that business is worth a lot. And then the other businesses that you see from valuations of all the peers isn't worth that much, right? They like sports. They like ESPN. That sounds like it's staying. But like there's still open debate about what do they do with ABC and the Fox assets they bought. And that's not going to end anytime soon. But our point has been, it doesn't really much matter because the core is, studio, film, Disney Plus, and those other assets are so lowly valued that it's not going to matter. You really need to stop the wasteful spending and streaming and focus on the core, which is what we heard last night.
So another issue, Michael, is Bob Iger. We love him. He's been great for shareholders. He's kind of put himself in a box once again in terms of timing and succession. Anything new there? Do we read anything into this new external CFO being hired? How do you think about that now?
Yeah, it's a good question. The CFO externally is interesting because I don't think there's been an external CFO in 25, 30, in a long, long time. So I think that person is going to come in, Hugh Johnson from Pepsi, is going to come in and look at the cost structure. I don't see him. I don't know him, but I don't see that as an air replacement for Bob. I think the question is going to be, for the new CFO, where is their wasteful spending? What can he do to bring kind of a Pepsi discipline to Disney? But I still think you still have an open question about who replaces Bob. It's not easy because of the diversity of operations. We've been saying, look, maybe break the thing into two again. And I think if that's the case, the park side will rise in value in terms of the management team. But I think as the company stays as Disney, if they don't change the structure, it's a hard job to fill. Yeah. I don't think the new CFO is on that short list yet because he's never worked in this industry before.
Sure. All right, looks like everybody's back to work in Hollywood, first the writers and now the actors. How is this going to play out over the next several quarters in terms of production and releases and all that stuff?
That's a good question. I'm amazed that it's been firstly so long, that the strike has taken so long to resolve because it's been really damaging to the ecosystem. I think people get back to work in the next, well, you have Thanksgiving coming up, right? So probably December, January, you probably get yourself a content slate and output that starts looking more normal by the February timeframe. But you basically just had 6 months of training people not to watch broadcast TV for content, not to go to the theaters for anything besides Barbie and Oppenheimer. I think it's just really bad. I think people do change behavior, and it's hard to get them back. And so, people will be back working, but I worry about what happens on the other side of this. I really do.
All right, Michael. Always appreciate getting a few minutes of your time. Some of the really most thoughtful research out there, in my opinion, on the media entertainment space. Michael Nathanson, he's a founding partner and senior research analyst with Moffettnathanson. Good news from Disney last night. The stock is up 7% here today, although it's only up 4% year to date, kind of reflecting a lot of investors still remain really unsure as to the trajectory for this industry as it tries to pivot from the traditional media model that they had all enjoyed over the last 30, 40 years, which is you and me paying $80, $100 a month to our cable company, and that a lot of that flowing right to the media company. So that model is no longer in the forefront here. It's all about streaming, and there are different economics there, and these companies and these investors are trying to figure out how that really plays out over time. Michael Nathanson, really one of the top folks on the street.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The market loves AI. The market loves ETFs. So let's create an ETF that focuses on AI. And that's what our next guests are doing, have done, will do. Francis O, APAC CEO and head of AI ETFs for Qraft Technologies, APAC. A lot to go there. Young Choi, director of AI business development and strategic partnerships at LG AI Research. A lot of stuff going on here. Gentlemen, thank you for joining us here in our Bloomberg Interactive Broker Studio. What are you guys building here? What are you guys launching? I'll let you guys figure it out.
Right. Thank you. First of all, thank you for let us sharing our stories in here. Yeah. So the Qraft Technologies and AI and LG AI Research, we just launched our latest AI-powered ETF, the ticker LQAI.
LQAI.
Tuesday on the New York Stock Exchange. So this one is special because so far we have in the Qraft, we had the 4 ETFs in NYSE, but this one is first ETF, that co-branded one, together with LG. So we take and leveraging on the LG AI's their own AI model combined with us, so delivering to a new alternative to entering into the US large cap markets.
All right, so Young, what did you guys at LG AI Research, what do you guys do? What do you bring to the table here?
They bring the model.
Exactly.
Good.
Yeah. So we basically power this product. LG AI Research, just to give you a little bit of background, we are institutional fundamental research for LG Group, which is a holdings company for LG Electronics, and we do various different researches in areas such as text, image, vision, all the good stuff. And on the applied AI side, we have what's called a time series forecasting model powered by AI. So we are using this model to basically forecast the future. And that's essentially the engine that powers this ETF.
So what do you put into the model? I mean, first of all, the ETF invests, I'm just looking at the description page here, minimum of 80% of its assets in US-listed large cap companies. So what, like S&P companies?
Yeah, you can consider this large cap universe as around 500 to 700 names, the largest market cap in the US Stock Exchange. And this model is all having the different models to screening out 100 names on a 4-week basis. So by the process of the screening out and the weighting, we are leveraging LGI's technologies.
And then, so Young, what do you put into your model in order to forecast how these companies are going to do?
Yeah, so the data inputs are macro level data, fundamental 10Ks, and also the most recent price data. And we take what's called a multivariate approach when it comes to the modeling. So it's not just a single model. There are multiple models that are specific to a task. So there's a forecasting process, there's a ranking process, there's a selecting process, and a weighting process. And put all those things together, where our goal is to find hidden alphas using deep learning models.
Has this been tested?
Yes. So
and how's the performance been?
So within the group, we move a lot of goods across the sea, and we have used this technology on the supply and demand forecasting side, and have seen a lot of good results on the supply chain management efficiency efforts, and also on the purchasing of raw materials. So LG has a pretty big chemical business. And they also purchase a lot of different raw materials such as lithium and naphtha. And we saved a lot of money doing this, using this AI-powered AI forecasting model. And now we're sort of moving into the financial markets where there's very robust and abundant amount of data that will better sort of optimize our forecasting abilities.
I see. So you developed a model to help LG save money in its business, and then you realized that this model was also applicable to the investment space, and that's where you team up with Qraft, and now you have essentially 100 names, right? Yep. But it's an active ETF, so you can move things in and out of the. Right now, I see Netflix is your biggest holding.
Right.
You've got Cencora, McKesson, United Health, Intel, Lilly, Microsoft. These are all your top holdings, and they're big companies, so they're going to be relatively stable, I imagine.
Yes, it is relatively stable, but at the same time enough active, because out of the US large cap universe, we only choosing the 100 names on every 4 weeks basis. So with our existing ETF QRFT hold 350 names. This one is a bit more concentrated, 100 names too. So we are expecting the top names will be in and out of every 4 weeks of time.
So is the LQAI, is the AI ETF, which is different from your large cap ETF, QRFT?
Yes.
So is it focusing on companies that are going to benefit from AI?
No, it's not.
It's using AI to pick stocks?
Exactly.
Boom. Yeah. See, all right, it's all coming to me now.
Yeah.
Okay, so what does the model kind of solve for? Like, what is it? It solves for, what are some of the big variables? Is it sales growth, earnings growth, revenue, valuation?
Exactly. I mean, are you trying to look at companies like who's going to make the most money? Are you trying to look at companies, which consumers are going to pick this company versus that company? Or are you trying to look at, the stock market is going to rank this company highest? Because obviously, just because a company does well doesn't mean that the stock market is going to agree that it's worth more.
Right.
It's really all weather, right? So this AI agent uses neural network, which works like a human brain, right? So if you think about the traditional quant approach of investing, it's a bit static, right? But on the neural network and deep learning side, the AI model changes in between cycles, right? So we rebalance every 4 weeks, depending on the input data and the training that it goes through. It has the ability to adjust whether that's taking more risk or less risk. We have different scoring system that does that, and depending on the cycle, it'll actively and flexibly adjust to the markets.
So the model is actually, the first step for model is doing is predicting for target price for the next 4 weeks of time in the rebalancing movement.
I see.
At the same time, estimating for volatility of individual stocks, and model will generating the millions of different paths for the next 4 weeks of time. And then there's another agent, AI model as well, trying to find out of millions of possibilities, what will be the most likely situation at the time of the nowcasting. Then we choose the most likely one, and that will be the basis of the portfolio construction of this month.
Every 4 weeks, it rebalances. So is there material change every 4 weeks?
We are expecting, based on the backtest data, we are expecting around 20% plus in and out of the names on every 4 weeks.
Wow.
Fascinating stuff.
It's only been active for 2 days.
I know.
Yes.
So LQAI.
All right, so we want you to come in maybe 3 to 6 months and tell us how performance has been.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Igal Namdar, he is the founder of Namdar Realty Group, and if you know of him, it's probably because of his shopping mall purchases. He owns literally hundreds of shopping malls across the country, but more and more I've seen his name in among a very small list of office buyers, especially here in New York City. There's a big concern about the excess office inventory that we have and the difficulty of repurposing it for anything else. Abigail Doolittle joins us as well, because Abigail, you've been talking to Igal about this market. Igal, well, first of all, thanks for coming in. What do you think about this office market? What would lead you to buy here when it seems like, to use a very cliched phrase, it would be an attempt at catching falling knives?
Yeah, well, for the first thing, I'll tell you that as my philosophy into investments, we're like a contrarian investor, and we kind of like always buy when everyone's selling and we sell when everyone's buying. So that's our model. I agree that this is right now there's a lot going on in the office market, and I think that there will be a recovery. I'm not sure exactly if we'll ever go back to pre-COVID occupancies. But my thoughts are, if you can buy prime office buildings, avenue buildings, corner, great light and air, prime submarkets, locations, high quality stuff, maybe A or A minus, there's got to be a flight to quality where a lot of the B, C, and D office buildings will probably have to be repurposed. And so between the contraction of all that office space and being able to, people have to move to different buildings as the rents come down, you start seeing a lot of people shifting from different buildings. Between that and hopefully more people coming back to the office as more big corporations will have their employees come back, we think it will come back. But I think that...
But let me just, to get it straight, are you buying the A minus buildings, or are you looking lower down the ladder in terms of office? And then what are you paying compared to what the prices were pre-pandemic?
So I would say our first entry into office was in 2020. And no, at that point, we were buying an asset that was priced at 800 and we bought it for 400. It was not it was a great location, but as time goes by, we think things have gotten worse since 2020 and 21. And now our focus is more into the better quality assets. And of course, we want to buy it at a steep discount, but you also don't want to buy something that's never going to turn around, because you can get a big discount. And if it's never going to turn around as an office, then no matter what you paid between your carry and the time you have to put in, it won't be worthwhile. So our focus now is the better quality assets, like I said, avenue, corners, and hopefully that's going to rebound.
So Igal, your philosophy, you sound a little bit like Warren Buffett when you're saying basically that you like to buy when everybody else is running. He has a pretty famous statement that the time to be greedy is when everybody else is fearful, and be fearful when everybody else is greedy. And when we talked, we said that what you basically just said, that you make your money where you buy it. So how many properties have you bought so far? And in terms of the opportunity ahead, 1.5 trillion of CMBS is coming due by the end of 2025. When you put that together with the fact that here in New York, working from home, the vacancy rates, and then we had a conversation with another office investor a number of weeks ago. We were talking about the value of Third Avenue. He wasn't willing to put a price on it because I didn't think he wanted to sell out his friends so much. But you basically just said that there was a 50% haircut on that building. From a broad perspective, if you had to give not Class A and trophy, what's the opportunity ahead and for how long, I guess, here in New York?
I think if you take out the A assets and focus on the B and the C's, there will be a tremendous, there has been a big
More
decline.
than 50% down?
Yeah, some assets are down 70%.
That's what I've been hearing on Third Avenue. Somebody was saying that it's like 25 cents on the dollar.
Yeah, Third Avenue corridor, that area, the Midtown has been hit the most. They have a lot of space, and
And so are there a lot of other investors like you? I mean, I guess it's probably for the people who have the money and who have the ability to model it out, it's a great opportunity, really.
Yeah, we just...
Tough for other people, but...
Absolutely. I'm not an institution. It's all my own family money. So it's all sweat equity. So I really pay attention and I analyze deals and I look at the downside. And I think, like you said, the money is made in real estate on your purchase. And if you can buy good assets at a good discount and you just have patient capital to wait for market to turn around, and hopefully, I think the rates have a lot to do with it, because once the rates hopefully will go down, then you're going to see the asset values hopefully increasing.
Well, do rates have to go down? Like, if we're in a new normal and rates are going to stay where they are and Jay Powell is going to actually stick by higher for longer, at what point does that cause any breakage?
Well, I mean, the rates, my own humble opinion is they would have to go down in the future. It's just, I don't know if they'll be back to zero rates. I think it would be somewhere in between the 5.25% that was raised and what it was before that. But I can't see the rates never going down. I mean, home mortgages where people were paying 2 somewhat percent, now they're at 7%. How could the average person survive with a 5% increase in their rates? I mean,
the 1980s.
Yeah.
Or 70s and 80s. You know, something that we talked about also is, so you, of course, are known as a big distressed mall investor. Based on some of my work, you're known as one of the 2 big mall distressed investors, and you told me that people know when they have to sell something quickly without due diligence and turn around, that you are known as somebody who can do a cash deal pretty quickly. But you were saying that for some of these properties that don't work out, that you sometimes will then tear the building down and redevelop it, but that right now, because rates are so high, it's really hard to do construction. So what does that piece of your business look like?
So regarding our mall business, I wouldn't say we're focused on distressed malls. I think we're focused on distressed loans, which are over leveraged.
Okay.
Our best purchases are maturity default loans that the assets are on their own doing well, but there's just too much debt on it and the owner can't refinance unless they put a ton of equity. Therefore, the lenders are taking them back and they just want it off their books. And again, the opportunity to buy at the right basis, we go in there. So we're focused on having that. And our main focus on our malls is to keep them as malls, because we believe there's a future for brick and mortar. And in some events where obviously some malls do go down, then we look at that as a redevelopment into something else. And in our case, since we have patient capital, if we have to wait a little longer for the rates to go down or find the right JV partner to come and join us or potentially sell it to another group, and then we do that.
But you, in malls, at least as far as I've read, you haven't been focused on the higher end properties, right? It seems like you have a slightly different strategy in New York office than you do in your big mall business.
So in the mall business, again, when we started back in 2012, we didn't know much about it. We were buying the C's and the D's, as they categorized it. But I would say in the last 4 or 5 years, our strength is really B market. A malls are just overpriced, and it's just not what we do. But our focus is more towards that B. Maybe it's the best mall in a smaller market. Maybe it's just second mall in town, but we look at their sales and the health ratios of tenants, and we look at occupancy and kind of project out, we want to buy assets that we feel have a long-term, potential to stay as a mall.
All right, well, we're going to talk to you on Bloomberg TV in just about an hour's time, so I'm really looking forward to that. Appreciate you coming in, and Abigail Doolittle as well. Abigail Doolittle there, and Igal Namdar, he's the founder of the Namdar Realty Group, talking to us about New York office. Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.